What's up, guys? Today we are going to work on preparing the operating section of the cash flow statement. Okay, so the first thing we always start with is net income. Okay, so our net income or profit, in this case, it's the same thing, is 98,500. Okay, and usually the first thing we look for is non-cash expenses. Okay, and the most common are depreciation and amortization. So I'm not seeing anything in the expenses section, but if we look in the additional information, we can see depreciation expense of 31,500. Okay, so we would add back depreciation of 31,500. Okay, why do we add this back? Well, this represents a non-cash item. We did not spend 31,500 in cash to expense our depreciation, right? We already spent cash on the asset when we purchased it. So the next item would be looking at our current assets. All right, these are our assets that pertain to our operations, things like accounts receivable, inventory. We can see here we have accounts receivable increased by 82,500. So we would subtract this from our net income. Why would we subtract an increase in AR? Well, this represents sales that we did not collect on, right? If our AR increases, there's no increase in cash, but this is still included in our net income number, okay? So we need to back that out. The next thing we need to look at is changes in inventory. So we have beginning inventory of 68,500. We have purchases of 160,000, and we have sales of 170,000, cost of sales. So that means our inventory is decreasing by 10,000, right? We start with 68,500. We have purchases of 160,000. We have sales of 170,000. So our ending inventory is 58,500, or a decrease of 10,000. Okay, when we decrease inventory, that represents an net increase in cash, right? We're selling stuff. Okay, so we would actually add this back. So that represents all of our current assets. Next, we're going to move on to our current liabilities. Okay, so the first thing is our accounts payable. Okay, so we have an increase in accounts payable of 3,250, which means we purchased inventory that we haven't paid for, right? So there's no cash being exchanged, but it's still hitting our income statement, right? And an increase in expenses, cost of sales in this case. So we would add back our increase in accounts payable. Okay. Our next item is wages payable. Wages payable decreased by 6,250. Okay. So what happens when we settle a liability? Well, we're paying it off. So we would have a debit of wages payable. This is the net effect, and a decrease of cash of 6,250. Okay. So we're going to subtract wages payable. Okay. If we net these, this is a change of minus 1,250. Okay. So if we add our net income, 98,500, adding back our depreciation. So netting all these together, we get 128,750. And this is our cash flows from operating activities. And that's how you do it. A nice shorthand to do this is when you're looking at your balance sheet accounts. Okay, you have your current assets, your current liabilities. Okay. And we subtract our increases, right? If we have an increase in AR, that means we didn't receive cash for those sales. So we would subtract increases in current assets. We add decreases. When we decrease an asset, we're receiving cash for them. Okay, and for current liabilities, it's flipped, right? We add back increases. And we subtract decreases. So that is how you do cash flows from operations using the indirect method.